Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back in 2023 for another weekly update with our friends at Strategas. Today, I'm thrilled to be joined by Chris Verrone. Chris is a partner at Strategas and head of their technical and macro research team. Chris, how are you doing this morning?
I'm doing great. Happy New Year. Great to be back here.
Yeah, great to have you back. And you suggested kind of hitting your best guesses or themes for 2023, and I think it's a great way to kick off the new year. So I wanted to start with your thoughts on rates and inflation and where you all might diverge from consensus a bit with inflation has peaked, but perhaps rates remain sticky. Could you talk about that a bit?
Yeah, Russ, it's a great question, and I would underscore, right? These are our best guesses for 2023. We approach markets not really through the lens of forecasting, but rather suggesting, what comes out of the deck today and how does it change our thinking. And we've been very much of the view that rates would stay sticky longer than the consensus anticipates, irrespective of what the inflation side of the equation does from here. And I think there's clearly data points that would suggest the pace of inflation has slowed or is topping, but I would be careful thinking about that as some investable theme for what bond yields do from here. I think at the end of the day, the immutable fact is that we have other countries selling a lot of U.S. treasuries. We showed recently in our work, the Japanese, for example, are selling treasuries at their fastest clip in roughly 20 years. So irrespective of what the inflation data does, we have very big sellers of U.S. debt. And I think that's likely to keep a floor under U.S. Treasury yields. I would be surprised if we saw yields, say, much below 3.25 or 3% this year, and we still like the idea that yield can actually work higher from here, looking out over coming months and coming quarters.
Yeah, and that's obviously a big theme. That has implications both for the fixed income market and for what the cost of capital, for equity should be. Speaking of equity markets, one of your all's themes that I found really insightful over the past year plus has been the idea of owning the average security over the top of the market. And if I am reading your all's writing correctly, I think you're still skeptical of that kind of top of the market, big tech, mega cap tech complex. Could you talk about how you see that playing out in 2023?
Yeah, that's right, Ross. And I think you're spot on. This has been probably the most important theme in our work the last 18 months. It was basically born on a skepticism of the top of the market. We had just thought that the big weights had gotten too big. At one point early last year, the five largest names in the S&P were approaching 30% of the index. It's not a number we've seen in history before. And I think the process of unwinding that, which began last year, will take many more years in front of us. And I think that's really a relative performance story, that we're not going to go back to the same stocks as leadership. It's not going to be the big tech and big growth weights that lead us out of this bear market. And I think on the other side, what we continue to like is what we've called the average issue, the average stock. We've been, big proponents of owning the equally weighted S&P over the cap weighted S&P. So I think that's certainly a theme that was relevant in our work the last 18 months, and we fully expect to be relevant in our work moving forward.
That's really insightful. You mentioned earlier, and maybe I should have followed up with this on thinking about how international investors are responding, with U.S. Treasuries. The dollar is another big piece of the macro picture. Its rise was ascendant, and then over the last quarter has really weakened a bit. How do you see the dollar evolving in 2023, and what might that mean for the U.S. versus international trade?
Sure. I think the dollar call is probably the trickiest thing to get right here, but might in many ways be the most important. I want to be open to a number of outcomes, but a lot of the evidence we see from different corners of the world is what we've described as capital is being called home. I think the relative appeal of U.S. assets is deteriorating, and the relative appeal of foreign assets is actually starting to increase. And central banks around the world starting to move at a similar pace as the Fed already has, I think creates an environment where rate differentials means capital can be treated better elsewhere. And I think we see that with the strength in gold. I think we see it with the moves we've seen in European bond markets or Japanese bank stocks. So there's a lot of evidence, I think, around the world, maybe the most important of which is actually how well European equities have acted here, is that capital is returning home. I don't mean home back to the US, I mean home back to its respective places. So a big theme for us kind of in 23 here is the idea that US underperforms rest of world.
Well, and you mentioned looking outside of U.S. stocks at assets that are performing a little bit better. And you mentioned gold. Let's end here. You all have started to get pretty bullish on gold and the outlook for gold. Could you talk about that a bit?
Yeah, the old pet rock, right, as they call it. We like gold here, and I'll preface this by saying I'm not a gold bug. I just simply am intellectually flexible, and when an asset gets momentum and relative strength, it certainly attracts our attention. Here's what I think is notable about gold. I think number one, the weaker dollar story is certainly important. We think of gold as currency. And gold, best we can tell, is the strongest currency in the world right now. I think secondly, and this is important, gold has started to outperform financial assets. Remember, the S&P bottomed back in early October. In that period, in that subsequent 2 or 3 months since, gold is actually up more. So you don't have real returns in equities. Gold has outperformed financial assets over the last 2 or 3 months, particularly bank stocks. So when I think about this thematically, the call we've made is this is about owning rock over paper. In the last 10, 12 years in the quantitative easing world, it was all about financial assets over hard assets. I think we flipped that in the quantitative tightening world. This is about owning rock over paper, a big theme for us in 2023, Ross.
Chris, I can't really think of a better way to start out a new year for our clients and investors. So I want to thank you for the time, and hopefully we'll get to talk to you again soon.
I look forward to it. Take care.